I set out to look for these repeating phenomena in price. And I started seeing these things in, at the time, I was looking at open, high, low, and close bars. So that really puts a big strain on one's eyes. And I was never really early on a fan of candlesticks because I thought it was like a cop out. Like, this is like preschool. Who the fuck wants to look at that? A real chartist looks at the left tick, which is the opening price, one single line up or down, which is the open high. I'm sorry, the high and low, and then the right tick to the vertical line that creates the high and low. That's the closing price. So it's open, high, low, and close. So I put off using candlesticks for a long time. I wish I would have done it sooner. My vision probably would have been spared a whole lot of fatigue over the years looking at that shit. But I was looking at fair value gaps through the lens of a open, high, low, and close bar. It looks a little bit different. You got to really look at the ticks on that little tiny vertical line that makes up the bar interval, whatever the time frame you're looking at. And there was charting packages that sometimes didn't have the closing price. It just gave you, I'm sorry, the opening price. It would just give you the high and low and the close. So we didn't have all the benefits. But here's the thing. Here's the thing, okay? Why would some charting packages, some charting platforms, not show you an opening tick? Think about that. That was a fucking clue to me. I'm like, why isn't this showing an opening tick? It just gives me the high and the low and the closing price. What the fuck? Where's the opening price at? Where do we start trading at? And it made me think that they're hiding something. The conspiracy theorist in me started thinking, okay, they're not sharing that. So what the fuck's up? Just like the Commitment of Traders report. We used to have to get that like every 2 weeks. And then it became an every week thing. But we still had to wait. It was a delay. It was a delay. It was a delay. And we had to wait for the volume numbers, what the real volume number was for the previous day's trading. We had to wait a day later. Why can't you have the fucking data today? Like, why can't you have that today? It was all these delays. See, you're right now, you're fucking spoiled rotten and you don't even realize it because you have all of this information right in this little thing that I'm talking into right now, this stupid fucking cell phone. You have the world at your fingertips. Swipe here, click here, boom, boom, boom. Open up an app. You got information immediately that we did not have in the 90s. And for folks that were trading before me, they didn't have it. Dinosaurs. We were fucking dinosaurs running around printing out the little tick. We had to guess on the chart. When we did our charts, we fucking wrote that little line, squiggly bullshit, on a graph paper. We guessed, okay, this is about where the opening price would be here in relationship to where we closed yesterday. There's no fucking measurement perfectly doing it. It's just eyeballing it. You know, the folks that's been around for a long time, Ken Roberts bullshit. We had to update our charts by hand. And some of you are so fucking impatient and entitlement minded, you can't even appreciate the level of technology you have today that I know I didn't have when I first started. So you can't track 20 motherfucking markets if you're doing the chart by hand each day. You'll never get anything done. And we updated what? Our stochastic indicator. Yeah, all that shit had to be done by fucking hand calculation. Okay, this is where the average would be here. The D line and the K line, and this is where they would be. Yeah, man, that's how it fucking was. It's worse than your grandfather walking to fucking school and the store with no fucking socks on and flip flops and knee deep fucking snow. You heard the stories too. Everybody hears the bullshit, right? But in trading, this is the really real shit. This is how it was. It was some archaic fucking shit that we had to deal with. And data was a premium commodity. If you could get your hands on data, that's what we were pursuing all the time. And I poured myself into that. And I started seeing these things repeating by reversing everything that retail would expect every trader using it would be doing. Just because an indicator says it's over fucking bought does not mean that's a short. Just because it's overbought and then it diverges bearishly doesn't mean it's a short. Even when the market's going down. It doesn't mean shit. Doesn't mean anything. It just means that you looked at a number of candles in that interval of time, you crunched the numbers, you beat the shit out of the data, and you finally made it submit to whatever output you want. That's what indicators do. That's all it does. And when you hear somebody say, we're optimizing our, your bullshit, your form fitting is what you're doing. There's no optimization. It's form fitting. That's what you're fucking doing. So when I looked at data and I looked at times where everything in my rules using retail bullshit said, okay, this is a buy. At that moment, I stopped, turned everything upside down, and I would go into the price action and say, okay, where is the fucking short? What things keep fucking repeating that cause this market to tear my ass up and go the other direction? And then it appeared. Order block, breaker, mitigation block, fair value gap, institutional order flow entry drill. What you know as the flagship, well, no, it's probably not the flagship pattern anymore on my channel, but the optimal trade entry, that logic, I saw that formed on a corn chart. The very thing that I looked for, I'm sorry, that's not true. I'm thinking of the reflection pattern. Reflection is the reverse of the optimal trade entry, where it makes the higher high. It usually forms the breaker. And some of you are like, oh, what did you just say? A reflection pattern. That's some old school shit, man. But those patterns, they were found by looking at shit opposite to what we're told to do. And you see when I'm executing, just read the comments. It's fun reading it. I love it because they're like, how the fuck is he doing that? Right. And that's exactly what I was saying to myself. How the fuck am I losing all the time? I bought all these books. I'm following every fucking rule these guys are saying. And every fucking time I do this, it's going against me. How the fuck's that possible, right? That's what most of us would think. If you're trying to stay in this, the smartest people are the ones that know they can't do this and they stop. That's wisdom. That's not weakness. Because if you know you can't do this, you want to know as soon as you possibly can come to that conclusion, so that way you don't waste any more money, no more time, and no more peace of mind. But if you listen to things like I'm doing right here, you're a fucking trader. Nobody would listen to somebody bloviate like this unless they absolutely fucking love trading. They love everything about it. They love the analysis. They love the lifestyle. They love every detail, everything that makes up this industry and what it is. You live and breathe it. You don't really like me. You just like the fucking shit that I'm sharing with you because it's empowering. You know a superpower when you fucking see it. And that's what I'm sharing. I'm teaching you how not to be a victim to fucking retail kryptonite. This Superman ain't got no fucking concern or worry about retail bullshit. That's never going to beat this. And because this is the market, that's why I tell you all the time, don't be fearful, because this market wizardry is going to keep on fucking rolling. Even if people come up and say, oh, well, you know, everybody's doing this now, you're becoming the new retail. No, because there's a new round of suckers coming into this that don't know what they're doing, and they're buying all the bullshit. They're buying harmonic pattern courses. They're looking at bullshit they call harmonic, algorithmic horse shit, and it loses their fucking money. You put that against something like this, this is beating its fucking ass. Day in, day out, month after month, year after year. The data doesn't fucking lie. Period. Receipts every fucking day. Every fucking day. Proof, precision, foresight. It's all being shown to you. You cannot fake this. You can't fucking Mickey Mouse it. It's 100% in your fucking face. You can't hide from it. And why people want to wrestle with it, and it's like, oh, well, this is a fad right now. I guarantee you, they're going to talk about this shit even when I'm gone. When I'm no longer among you, okay? They're going to talk about this stuff. It's changed everything. And you watched it. You're part of it. That's exciting. Like, you were here when this shit happened. You're living in a fucking Gann moment. Think about that. Like, you're here. That's not an inflated, egotistical thing to say. It has nothing to do with me. It has nothing to do with me. It's this phenomenon, this approach to deciphering price, reading it, forecasting it, and engaging it on a level of precision that is unfucking rivaled. Period. You're learning a language that you've never been exposed to. None of you have been. Not one of you have ever seen this before. You see a rectangle, you think it's supply and demand. No. You see me talk about a specific candle. Oh, that's a supply and demand zone. No, it's not. That's a change in the state of delivery. Where that candle's opening is, that is the change in the state of delivery. And there's 3 reference points. There's 3 specific price levels that you need to know about an order block. Look at supply and demand zones. Who the fuck knows what you're going to do with that? Where's your price? What price are you going to look at? Which one are you not going to consider at all, ever? That's how you know my theory is not supply and demand. And I'm cutting through candles. I'm telling you the high tick and the low tick of the day. I'm telling you the moment when the volatility is going to come into the marketplace and start running towards the objectives I've already given you. That's what market wizardry looks like. That's what it looks like when somebody knows what the fuck they're doing. Today, I recorded something that you would have never seen if I didn't want you to see it. If I didn't want you to see it, you never would have saw any of it. But I want you to see it. You saw me put the trade on. I told you the level. I said it goes to 4,000, I think 4,000.75. I said it kills the short idea. Whenever I tell you that, that's a stop loss area. That's not me telling you to take a trade now, but I want you to track the ideas that I'm giving you. If it goes back to those levels, you got to think about it as, okay, that would be a stop out. You shouldn't have a trade on. You shouldn't do that. But it went to it and stopped me out. But when it hit it, it returned back into the range that I would consider still worthy to take the trade. And that was a run on liquidity. In that instance, I was liquidity. It took my balance at the open position. I had already took a partial off, and it came back and stopped me out. No problem. Didn't skip a beat. Okay, check. Everything's good. I'm going back in. You're going to see me do that and reverse. When I see something, okay, this no longer is valid. Something else has changed. And now I'm going to go the other direction. Everybody that blows their account always can see it in hindsight that they pushed really, really hard when the market wasn't doing shit. You have an outcome that you need to have happen. On a social media equity curve, you need to make yourself feel better because your spouse or your significant other has caused you some grief. You're sick. You missed some days at work. You're behind in bills, or you're just in debt. What's it going to do? It's going to cause you to do reckless bullshit. You're going to know not to do that by November. Well, before that, really. But by November, you'll know when not to do anything. You'll know when not to touch any of that stuff. You won't go into the marketplace. You won't do these things. And you'll know what you're specifically looking for when you're going in environments where it's low resistance. You'll know exactly what constitutes a high resistance or low resistance climate that you're trading in. You can trade in high resistance, but you'll also know that you'll be using far less leverage. And you're going to have to demand a whole lot of patience that you would otherwise not require when you're trading in low resistance liquidity run, where the market's really quickly running for you. It goes right to your objectives. That's what you're wanting to focus on. You want to focus on those types of setups. They're fun. They're easy to know when they're going to be there, because those signatures are like, they're very telling. And you see it when I talk about it in my executions. I'll say, all right, I'm looking for a lot of movement, or I'll tweet and say, okay, I want to see it be a straight run into this now. That's a low resistance liquidity run. When we are quiet and we're waiting for price to just chew through some old market structure, that's high resistance. It's high resistance. It's not moving quickly and efficiently through and to your objective. So it takes a different type of mindset to go through that. Now, when you're first learning how to trade, you think that all trades are going to be like a low resistance liquidity run, where you get in, it runs because it owes you something, right? It owes you that profit. The fucking market doesn't owe you shit. It doesn't owe me anything. But these books and influencers make you feel like, well, hey, you sat down, you watched that chart for the last 20 minutes. You damn well better pay me something, because it owes me something. That's the mentality, especially today. The last 25 years, this is the mindset of most everybody. You owe me. You owe me. No, you have to earn that shit. And by discerning the difference between high resistance and low resistance liquidity runs, you'll be able to effectively trade, and you'll grow to appreciate and want to trade more so in low resistance liquidity run signatures, where the market just quickly just runs. It has these really nice big candles. It just takes off and goes right where you want it to go. I know how to teach that. I prove to you that I can see it happening before it happens. There's a logic there. That's what you're going to know come November. You'll know that. You will absolutely know it. Will you lose in some of your trades? Sure you will. You'll lose, and there's nothing wrong with losing, because money management, which we'll talk about also this year, will prevent you from blowing up. You don't have to be fearful of it. You don't have to worry about missing moves. You don't have to be in every trade, and you don't have to be in every market. You can pick one market that you feel confident in, that you like, and then that's all you need. It makes it so much easier. You know what those key levels are. Think about what I'm teaching you. New week opening gaps, new day opening gaps. Just that alone, and the enormity, I'm making up shit as I go along, the enormous responsibility of managing all that shit on your chart and templates, because new day opening gaps, there could be a lot of them, right? So how much of that can you do if you're trading 12 pairs? Well, wait a minute, ICT, what if there's no new week opening gap? Here's what you're not doing. When you look at Aussie dollar, this is the part where you write down in your journal. If you look at Aussie dollar, that currency pair has what? It has a commodity currency in it, Australian dollar, which means it trades on the futures market. That futures contract is going to have an opening gap. You use the price on the futures market, and you use that in reference to what the pair's doing while the futures contract's printing too. I was teaching you with real-time examples this week and last where I'm using intermarket relationships and intra-market relationships. So I'm blending other assets, positively and negatively correlated markets, how they influence each other and how they dance together. All those things come together and give you a tapestry that you can really see everything. For the life of me, I can't remember which one it was. There was a Batman, Chris Nolan, I think it was the last one where he was doing Morgan Freeman did something with the cell phone, and all of a sudden all the monitors in front of him was like giving like an x-ray view of some shit. Okay, that's kind of like what this feels like. It feels like that, to put it like a little bit of a cinematic flair on it. When you're able to see behind price what it's likely to do. Think about it. When I first introduced the idea last week or so, I said, you want to look at the opening price on Sunday and the closing price on Friday, and then split that range in half, and also do it in quadrants. So you have a number of specific price levels. I also taught you that if it works towards just half that lower end and fails to go in the upper end of it, that means it's what? Decidedly weak. And vice versa. If it's coming down, it can only dig into the upper portion of it and not get to consequent encroachment, which is the midpoint. That means it's bullish. By itself, that doesn't mean anything. But if you have a narrative that you think the market's going to go higher or lower, and you see that unfolding, it gives you a real advantage. It also teaches you, if we're moving away from the new week opening gap, then we're probably in a trending model, which is what I talked about yesterday, real time. Told you we're going to have a large range day. We got a large range day. You can't fake it. It's there, real time, explained to you.